Most people don't think much about the money in their bank account. It's there. You can see the number on a screen. You can spend it, transfer it, withdraw it. The system works. And because it works, most people never stop to ask why it works, who it depends on, or what happens when it doesn't. But there was a moment, not that long ago, when the question stopped being theoretical, when ordinary people in the wealthiest economies in the world opened their newspapers, turned on their televisions, and watched the institutions they had trusted their entire financial lives begin to fail. And somewhere, in the middle of that moment, in the confusion and the anger and the loss of confidence in the system, something new was quietly being built. This is the story of why Bitcoin exists. Not what it is technically, not what its price has done, but why, what problem it was trying to solve, where that problem came from, and whether, more than 15 years later, it has actually solved it. To understand Bitcoin, you first have to understand 2008. Not the headlines, the mechanics. For years leading up to the crisis, banks had been lending money to people who couldn't reliably pay it back. Mortgages were being issued to borrowers with little income verification, packaged up into complex financial products, and sold to investors around the world as safe assets. The assumption baked into the entire system was that house prices would keep rising, that even if individual borrowers defaulted, the underlying asset would hold its value. That assumption turned out to be wrong. When house prices started falling and defaults began rising, the value of those financial products collapsed. Banks that had bought them found themselves holding assets worth a fraction of what they had paid. Some of the largest and most trusted financial institutions in the world discovered they did not have enough capital to cover their losses. What followed was something that most people alive at the time had never seen. Banks that had operated for over a century faced collapse within days. Governments were forced to respond quickly, choosing between allowing major financial institutions to fail or intervening to stabilize the system using public funds. In most cases, they chose intervention. As a result, public money was used to support parts of the financial system during the crisis period, particularly in the United States, the United Kingdom, and across Europe. While these interventions helped prevent a wider collapse of the financial system, they also contributed to a long-lasting shift in public confidence. Many people question the resilience of financial institutions, the effectiveness of regulation, and the broader structure of the global financial system in the aftermath of the crisis. These concerns about trust and systemic risk became part of the broader context in which Bitcoin emerged. In October 2008, the same month that governments around the world were scrambling to contain the financial crisis, a document appeared online. It was 9 pages long. It was titled Bitcoin, a peer-to-peer electronic cash system, and it was published under the name Satoshi Nakamoto. Nobody has ever definitely established who Satoshi is. The name could belong to a single person. It could be a pseudonym for a group of people. Multiple individuals have been proposed as candidates over the years, and none has been conclusively confirmed. The true identity behind that name remains one of the genuinely unsolved mysteries of the modern internet. What we do know is what the document said, and more importantly, what problem it was designed to solve. The core argument was straightforward. The existing financial system relied on trust at multiple levels. You trusted your bank to hold your money. You trusted central banks to manage monetary policy, and you trusted governments and regulators to maintain stability within the system. In 2008, confidence in each of these areas was significantly strained. The Bitcoin white paper proposed an alternative approach. Instead of relying on institutional trust, it described a system where transactions could be verified through cryptographic proof on the decentralized network. No single bank or central authority would be responsible for maintaining the ledger. Instead, verification would be distributed across participants in the network, a currency operating outside the control of any single institution. The timing was not accidental. Embedded in the very first block of Bitcoin ever created, what is known as a Genesis block, was a line of text referencing a newspaper headline from January 2009 about a second bank bailout. It was not a technical necessity, it was a message. A statement of intent from whoever was behind the name Satoshi about exactly why this thing was being built. Bitcoin was not invented despite the financial crisis. It was invented because of it. So what actually is Bitcoin? At its core, Bitcoin is a form of money that runs on a decentralized network rather than through a central institution. When you send Bitcoin to someone, that transaction is verified and recorded not by a bank but by a global network of computers, all of which hold a copy of the same transaction history. That record, the blockchain, is effectively impossible to alter after the fact without the agreement on the majority of the network. The supply of Bitcoin is also fixed by design. There will only ever be a certain number of Bitcoin in existence, written into the code itself, unchangeable by any government or institution. This was a direct response to one of the central criticisms of traditional currency, that governments and central banks can create more of it whenever they choose, diluting the value of the money already in circulation. Bitcoin was designed to be resistant to that. What this means in practice is that Bitcoin operates on a completely different set of assumptions to traditional money. Traditional money derives its value from institutional trust and government backing. Bitcoin derives its value from the integrity of its code, the size and security of its network, and increasingly from the collective belief of the people who hold it that it has value. That last point is more important than it might seem. All money, at some level, is a collective agreement. The dollar or pound in your pocket has value because enough people agree it does. Bitcoin asks the same question, but removes the institutions from the middle of that answer. For the first few years of its existence, Bitcoin was largely unknown outside a small community of cryptographers, technologists, and people with a particular interest in the politics of money. Its early history includes moments that are now almost mythological in the cryptocurrency world. The first real-world transaction involved someone paying for 2 pizzas. The price of a single Bitcoin at that point was essentially nothing. For a long time, it remained that way. What changed the picture was a combination of factors that are worth understanding because they tell you something important about how Bitcoin actually grew. First, it became a tool for people operating outside the traditional financial system for legitimate reasons in some cases, illegitimate in others. This gave it a reputation that it spent years trying to outgrow. Second, it attracted attention from people who saw it not primarily as a currency but as a store of value, a digital alternative to gold, a hedge against inflation and currency debasement. This reframing shifted the conversation significantly. Bitcoin stopped being talked about primarily as a payment system and started being talked about as an asset. Third, and perhaps most significantly for its trajectory, it attracted institutional money. When large investment firms, publicly traded companies, and eventually sovereign wealth funds began allocating capital to Bitcoin, it crossed a threshold. It became part of the mainstream financial conversation in a way that its original architects, whoever they were, almost certainly did not anticipate. From a practical experiment built in the shadow of financial crisis, Bitcoin had become one of the most discussed and debated economic assets in the world. So the question worth ending on is the one this video started with. Bitcoin was created as a direct response to a specific problem, a financial system built on layers of institutional trust that had visibly failed. A system where ordinary people absorbed the consequences of decisions they had no part in making. The white paper proposed an alternative where trust was replaced by mathematics and where no single institution could hold that kind of power. Has it solved the problem? The honest answer is complicated. On one level, Bitcoin exists and works. Millions of people around the world hold and transact in it outside of the traditional banking system. In countries with unstable currencies or unreliable financial institutions, it has provided genuine alternatives for people who had very few. The technology it introduced, the blockchain, has influenced far more than just cryptocurrency. But on another level, Bitcoin has evolved into something quite different from what the white paper described. It has become, for many of the people who hold it, primarily a speculative asset, something you buy not because you want to replace your bank account, but because you think the price will go up. The institutional money that flooded in brought with it exactly the kind of financial complexity and concentration of power that Bitcoin was supposed to be an escape from. Whether that represents a failure of the original vision or simply the inevitable reality of how new financial instruments get absorbed into existing systems is a question that people who think seriously about money disagree on. What is not in dispute is that Bitcoin emerged from a specific moment of institutional failure, and that the questions it was asking about trust, about who controls money, and about what a financial system should look like remain as relevant today as they were in 2008. At Macro Breakdown, we break down the economic forces shaping the world, clearly and without the noise. If this video gave you something to think about, subscribe and we'll keep covering the stories that matter. Drop any questions in the comments below.